Hey folks, welcome to CFO Chat, your front row seat with the Chief Finance and Value Officer. Anytime a corporate action happens, this is where you get the full lowdown. And guess what? Banking sector half-year numbers are rolling in. Stanbic Bank is here with their numbers HY 2025. And as always, we're privileged to have Dennis Musau. Dennis, karibu sana.
Asante sana.
Welcome on set, Dennis.
Thank you.
Dennis, you know, you and I have a long history of conversations.
Yes.
The last time we sat here, about a year ago, I asked, what happens when the FX tide recedes from your non-interest income margin standpoint? And you did say the banking sector is well prepared, well calibrated for it. When I look at the numbers, granted, Q2 has really clawed back from the shock we saw in Q1. How do you characterize your earnings?
When we spoke last time, Julians, the FX margins were already receding, right? Last year, FX margins went down 300%, 3x from 2023. Remember, 2023 is a time when we had significant FX liquidity challenges, and that, of course, expanded margins. So when we were speaking, the movie was already playing on FX. And in fact, by the end of the year, we recorded a reduction in FX earnings, not only at Stanbic, but also across the industry. One thing I will admit is that we didn't think the movie would continue playing. So as we speak today, FX margins have contracted further by 42% compared to H1 last year. Of course, that's caused a lot more squeeze. Yeah. In my presentation earlier today, I showed that the banking industry, Q1 last year to Q1 this year, showed a 53% contraction in FX income, right? But we showed a 2%, about a 3% increase in earnings at an industry level.
Yes.
So the industry is prepared, the industry is well diversified. Banks have continued to increase the surface area of earnings over time. At Stanbic, our FX income standing alone went down 58%, 58% on account of the fact that we are a major player in FX. 58% coming at 9%, I think that is evidence that the surface area of earnings is wide enough for Stanbic Bank.
So would you say that your play around FX is changing in the sense that you're moving from the margins to the volumes?
Yes, it is. It's not changing just for us. It's changing for the industry. There is an expectation that, so the beauty with, you know, and I know the exchange rate has been largely at the same spot for a while now. The beauty with that is you have confidence in the market that when I go out there and I want dollars, I'll get them. So you don't have to hoard and all that. What that has done is that we've seen more volumes. So there's no more, you know, dollars held because you can access them. We've seen a 24% increase in our FX volumes in this, period, which is very good. In fact, some of the debates we had internally was to say, were we actually extracting as much of volumes and productivity as we should have in the past? So we do expect that to expand. But also, the other part here is to say that earnings are not just FX. If you look at our non-funded income, it's actually gone up despite a 58% reduction in one major component. Here go trading income, which is trading activity, is gone on very well. What we also saw is that because we've been driving this transactability in volumes, we've seen our fees and commissions actually go up 9%. So that kind of tidies that canvas.
Wonderful. Your balance sheet, Dennis, looks a bit tepid to me, and this is what I mean. We are beyond the point where we can say, because of the FX revaluation, our loan book is contracting, is flat. Yeah. It looks like you have no appetite in this market, Dennis.
We are beyond FX adjustment.
Absolutely.
We are not beyond private sector credit growth malaise, are we? I mean, if you think about
it. That's a good comeback.
Look, private sector credit growth is critical. And in fact, I actually do think children in the future will study this period and understand what really was going on. Because private sector credit, you remember when we sat this period last year, I say to you, we had seen a significant contraction in private sector credit growth to 4.3%.
Yes.
How I wish it stayed at 4.3%, because now, I mean, towards the end of last year, we hit negative. Jan this year, we were at negative 2.9. We started to recover to 0.4. We are now at 2%. So what we have not seen...
Which is still anemic, to be honest.
It's very anemic. I mean, at a GDP, you see, in these parts of the world, you expect credit to be growing at 2 times, 3 times your GDP. GDP is printing at 4.7. So 2 times that is 10%. 3 times that is about 15%. Across the border in Uganda, private sector credit growth is growing at 12%.
Double digits.
In Tanzania, on the other side, it's growing by 15%. So there has to be something that we need to hazard and just find out what exactly it is. You can trace that to some government spending and some stimulus in the market. In Uganda, for example, the oil industry is driving a lot of that. There's a lot of FDI as a result of that. In Tanzania, I'm told, some of the cities and towns in Tanzania are construction zones. There's a lot of construction going on. So that's spurring demand for credit. Where is the stimulus in Kenya? It's quite, and now if you ask for government spending, you're kind of squeezed on the borrowing side, kind of squeezed on the taxing side. So it's really something that we need to reflect deeply. What for me is most concerning is that despite seeing reduction in rates, it's still not coming back. So there's a big item there for us to unpack.
And now moving away from the loan book, looking at your deposits. Yeah. One, when I look at your income statement, it looks like you unwound quite a chunk of the expensive deposit that you are holding. Give us some color into that. We
did. At this point last year, we held 355 billion worth of deposits, out of which 90 billion of fixed deposits. Yeah. You do remember at that time yields were very high,
insanely high.
So we were buying.
Yes.
We were buying to supplement asset demand, because although private sector credit growth was coming down, there was still asset demand. So we were still supplying a bit of credit and having to, fight against high yields. And therefore, a significant chunk of our deposit base was actually that fixed deposits. Now, today, that number has moved from 50 billion to about, from 90 billion to about 51 billion. So that's a massive
unwind.
Shrinkage.
Yeah.
And you can then trace that to the 355 to 330, from the 355 to the 330, and therefore you can actually see an expansion in current accounts. Again, you often see that when the yields have come down, and all of a sudden people are not too sensitive about rates. So it's been a reprofiling of the balance sheet, as it were.
But then, even as you talk about the credit risk in the market, I'm really intrigued by your NPL ratio. Mm-hmm. Considering the low digits at which you're playing and the kind of environment you're painting for us in terms of the picture here, shouldn't you be playing somewhere in the low teens, my own expectation, based on my historical analysis of Stanbic Bank? 9%. It's like you're in a different market.
It should be lower.
Lower than 9.
If you think about it, your denominator in this ratio has actually reduced.
True that.
So it should have actually...
From a mathematical standpoint,
yes, mathematically it has gone down. I think the one nuance that you need to just address is the fact that 62% of our credit is to corporates. All right? Another 15% is to commercial customers. So we're talking about 75%, which is to well-established businesses which have deep expertise in managing cash flows, etc., and therefore managing credit risk in those. And remember the principles I've shared before around managing credit risk. It is the origination, it is the monitoring, it is the recovery efforts. So that helps. And actually, when we compare our NPL ratio and the industry, we're always careful to contextualize that there's a bit of our balance sheet compared to the next bank B next door, which is largely corporate, and that helps. What I watch is the quantum. So if you look at the quantum of NPLs, 24 billion last year, 23 billion last year. The biggest challenge we have internally is to try and push that number further down. Write off whatever we can recover, and then recover what we can recover, cure whatever we can cure.
Would you say there are pockets in that book where you would assess the bank to be overweight and you really want to cut back on it?
In terms of
whether it is sectoral focus or in terms of your NPL?
Not necessarily. You know, the NPL happens very late in the game. Like the game started 10 years ago, someone borrowed, 5 years down the line, the business doesn't make sense. So the NPLs of today are the strategy execution of 2015 and 2017 and 2020. I would focus on just curing them. Our strategy today is to follow the sectors of growth of the economy. So you will see, for example, that we are the biggest lender in affordable housing today, by a mile, right? Why? Because the government and the public policy has said it is important to be big in that area. We are a major player in agriculture. 23% of this economy is driven by agriculture. So it is those sectors that we drive. Now in 2030, the person who sits here and explains the NPLs of that time might look back and say, hey man, you shouldn't have played that big in a Greek or affordable
housing.
etc. But for now, it is what makes sense to do to live to our purpose, which is Kenya is our home. We drive our growth.
Fantastic. Dennis, your dividend. You know, when I saw your numbers last evening, I was looking at it and I thought, Stanbic Bank is on a very tactical move to have the market especially wonder, do we look at the PAT, which is down 10%, or do we look at the dividend, which is up 100%? And then we are confused in our reaction. Help us arrive at the doubling of your dividend. Quite a sweet spot for your shareholders.
Julians, this should have been the first question. This should have been the first question. We are not trying to confuse the market. In fact, if there's something I enjoy in how we interact with our shareholders and our stakeholders is the consistency of our dividend policy in principle, not in numbers, because the numbers are an outcome.
Yeah.
When we start, you and I, because we go back a long way, in 2023, this point, we had grown our earnings by 41%. And then the dividend was kidogo. And then you asked me.
And we rattled.
Exactly. So, and it's a principle that stays. The principle is that we watch three things. We watch opportunities in the market for growth. You could argue that there haven't been as much if you follow the balance sheet. Do we expect some growth? Yes, which is why you will see our capital ratio is sufficiently above. I mean, the government, the regulator expects us to be at 10.5. We are at 15.2. So we have sufficient buffer to allow ourselves to grow. The second thing we watch is risk management. And just ensure that we have sufficient buffers to absorb any risks. Now, with a 500 basis points band, I think we have done sufficient. And with the fact that over time, we've built our coverage ratios on the NPLs, they're staying about 63-65%, which is kind of the sweet spot that we like. Anything after that, we've served our customers, we've served our employees by paying them.
Why not
we've served the government. What is wrong with paying the shareholders?
Which is a good point to be at. But I wondered, especially given the conversation we've had about the state of the market, the credit risk, and I thought, shouldn't Stanbic have adopted a little more caution, anticipating perhaps impairments further down the road, or whatever it could be, on the dividend side? It looks like provisioning will not be a headache for you. That's the signaling that I got, actually.
Yeah, not necessarily. Look, the buffer I've talked about is very big. Yeah. Let's do some math. Our capital carry today is about 60 billion. So if you're saying you're at 15%, it means that every 5% is like 20 billion. So to move from to impair your capital to the limits that have been set, we need to have an event that consumes capital or absorbs risk to the tune of 20 billion. Our impairments is 1.5 billion for the half year. So there's enough runway to allow for growth. Actually, I'm not too worried about impairments on the current customer base because evidence suggests that we have sufficiently provided for the ones that have had some challenges. We continue to manage the performing book quite well. If you look at the split between stage 1, stage 2, stage 3, I remember
we had that conversation a lot.
89 and 11, moving all the way to 82.99. We're still at 82.99.
Wow.
So I'm not too worried about the book.
So you don't have a flow problem, clearly?
We don't. In fact, it is the backflow problem that we are watching to ensure that we are able to flow back the 9 in stage 3 to stage 2 and the 9 in stage 2 back to stage 1. And then the 20 billion capital that I've spoken to, which you would have to multiple by 10.5% to get the balance sheet size you need. You probably need to double the size of the balance sheet we have today. I think we are safe.
I see. On that 500 bips, my friend Dennis, you've spoken about are there opportunities for growth and you're looking at them. You can also grow inorganically.
Yes.
And whenever I look at that 500 bips, I always get the impression that perhaps Stanbic is scouring the market and looking for something. And considering how much you want to drive a transactions-led business, the retail franchise can grow. I believe my question is made.
Your question is very clear. That question has been the number one question for the better part of the last 3-4 years. In fact, our Stanbic Holdings chief executive is on record as to saying that we are looking at East Africa, we are looking at Kenya as the next growth vector for Standard Bank Group. So that is not uncommon news. We have chosen and consistently choose 3 paths to growth. Organic, which we continue to execute. I mean, even as we look for all these other things, we have just built an asset management business, which when we spoke last time this year, we just had a license.
Yes.
No asset under management on the book. Today, 4.3 billion shillings on that book. Continue to build that. We continue to build our organic offerings on retail customers. We launched our new mobile app in August last year. As we speak today, it has hit more than 100,000 customers. And the level of activity for us is very exciting. It's more than 80% of those customers are very active. So we are continuing to show that. And if you're talking retail, that is actually evidence of retail. We are ranked as the number 5 most biggest lender to SMEs. Remember, we used to be known as a corporate bank.
Corporate, yes.
We are ranked as the number 5 biggest SME. So the organic play continues to be the mainstay, and actually, quite honestly, my daily job and our daily job as a leadership team. Then there is a second part, which is partnerships. And those partnerships continue. We continue to partner with telcos. We continue to partner with fintechs to intermediate certain things. And then, of course, there is the inorganic, which is the scouring that we're always doing. Now, that is always in play, always been looking for opportunities, not just here in Kenya. Standard Bank has been actively looking for opportunities across Africa. It's chosen specifically to be an African bank. It's chosen to be in more than 20 African markets. So that continues. Even when something comes along, we will have a conversation. Yes.
2 final questions, Dennis, because we are really overshooting our time here. 1, finally, we seem to have found a consensus between banks and your regulator around risk-based pricing.
Yes.
And you won over the regulator around the interbank as the reference point.
Yeah.
What should we expect going forward?
So for me, this is probably one of the points I am most excited about in terms of prospects of credit and banks keeping the social contract between depositors and society and the banking industry. Let's appreciate that there is an evolution to these models. We came from interest rate capping, we learned that when you cap interest rates, you exclude people from lending. We moved from that to risk-based pricing. What have we learned over the last 2 years? We learned that the intention was to be transparent, but your level of transparency and my level of transparency is not necessarily the same. I could say my base rate is 12%, you say your base rate is 15%. I look cheap, but when the customer finally gets their full level of lending rate, it's actually no better. The other thing that we learned was you can't rely on idiosyncratic factors to determine. This is not market facing. It was my cost of funds plus my cost of capital plus my cost of operations to come up with a base rate, which is not very, very competitive. So we've learned that from this model, and we have to appreciate the lessons that have come from that history. Where are we moving now? There will be a public rate, and it will be, I'm assuming the consultative process that we are in now gets to fruition, and I'm really praying that it does, actually. I think we need to get there. And then it will be a premium that we can all publish. We can publish, 10%. Bank B publishes a premium of 15%. Then we win the customer. There's a few discussions that are going on which kind of credit do you apply this on, because do you apply it on fee-based convenience products like cards? I think those are the minor items that are being ironed out. Do you need to apply this for everyone? Because studies that we've looked at, this kind of things, protection is actually mostly for retail customers, not necessarily for corporates. Corporates run competitive processes. They tell you to bid, and they want to observe the base rate. So I actually do think we are at a very good spot to get to a market observable, consistent base rate. Banks can then compete on the premium, which is informed by the efficiency in their operations. It's informed by their risk appetite and the risk premiums of the clients that they have, and their efficiency in capital raising, because that's going to come through there, and we can compete fairly. And then after that, customers can choose. Now, that day is going to fulfill the social contract between banks and society. But I appreciate the journey that brought us.
Dennis, my view has always been that when you disaggregate the K component of the premium, the operational costs that feed into that should not be on a case-by-case basis, should be case of who's the best in class. Why don't we use the most efficient and then price it for the industry?
That is a good argument, but you might then be ignoring phases of growth of different banks. Let me explain. If you pick a bank that has 30 branches or 50 branches and it's expanding because they are serving a certain sector and they're following certain clients, and compare that to a bank that has been around for 100 years, 200 years, potentially got some buildings free, many years ago, you're handicapping the ability of the next bank, because you're telling the investing bank during the investment phase, you can't price in your investments. Now, we do know that the investor, the carrier of equity, wants some return. Yes, maybe in the long run, but while we wait for the long run, we also need to eat today. So you need to balance that piece. What for me is exciting is if this bank has invested in digital scoring, it's expensive. But it comes with some benefits in terms of how you can scale. If Bank B has not invested, then there will be, you will benefit. Bank A will benefit from a lower K because the operational cost will be lower, and therefore to be able to serve customers. But I wouldn't go for take the lowest and then even it out. You will actually discourage investment in bank.
All right. Final question, Dennis, is how you're looking at your efficiency position. Of course, in the briefing, you did mention that we are not in the business of arresting costs if the costs are productive.
Yes. Yes. So 48, 45, 43.5, 40.4, 44, 48. it's kind of it's a trough.
Yes.
I'm watching the costs to ensure that the investments that we are making are going to the right spaces. I'm always very excited that the investments, when I look at the last 2 years, what have we really done? What have we really done? We've brought in new people or more people to the organization to serve our clients. We've invested in those people by enabling them through training to ensure, and that's a cost, to ensure that they can serve our customers. We've improved the efficiency of our core banking platforms. We upgraded it 6 versions just last year. We've availed new technology to our customers through our mobile banking app. We've revamped our SBG securities app. We have revamped and are revamping nearly 30% of our physical infrastructure today to ensure when you walk into a Stanbic branch, you actually feel like you are in a in one of the best private banks. Those investments are good. They come at a cost. Now, it just so happens that we're making these investments at a time when revenue, market, credit growth is not coming. But this is not a permanent issue. So even when, in fact, if I threw up some ratios on the revenue side and I look at the costs, we are actually achieving those targets that we set. So I'm not worried about the incidental movements today. Neither did I celebrate last year, by the way. Remember when we met last year and we were at 40.4,
yes,
and you asked me, you've overshot, you should move it. No, because we need to continue investing to serve our clients.
Dennis Musao, Chief Finance and Value Officer at Stanbic Bank, unpacking the half-year numbers. Remember, dividend has been doubled. PAT is down about 10%. We've been fleshing out everything in between, and we shall keep on highlighting these numbers because this is the earnings season. Next week, we are also quite heavy on the earnings for the banking sector, so stay tuned to CFO Chat.